welcome to In the Hot Seat. I'm Meg Muir, and it is great to be with you today. Today's episode, we have a very special guest with us, Dan Rutherford. Dan, welcome to the Hot Seat.
Thanks, Meg. I appreciate it. I'm looking forward to chatting today.
Yes, absolutely. We are as well. You have a wonderful and incredibly interesting background for our audience. I think many will be interested to learn more about the work that you do. So you began your career as a revenue agent, actually with the IRS, and eventually worked your way up into a role as a large case team coordinator, where you were responsible for leading large audit teams, often multinational corporations, and then actually spent 22 years as a CFO for two other large trucking companies. Is that right?
Yes. Back in my IRS days, Meg, I didn't get invited to many parties, so I decided it was time to leave. But yeah, that's pretty much sums up my career. Working for IRS for 11 years, which gave me a good solid tax background, which I still rely on a lot today. And then I worked as a CFO for two large trucking companies that are actually right down the street from each other.
Wow.
And
Okay.
knew each other very well. The families knew each other very well. So
Wow.
I watched them grow, and two family businesses. And then I ended up running the logistics division for one of the companies for 3.5 years. So I had a little bit of operational background, gave me a little break from being a CFO for a while, which was really enjoyable.
Yeah, that's great. So a lot of transportation and logistics experience. Maybe share a little bit more about those organizations. I know you're in Fort Wayne, Indiana. So
Mm-hmm.
maybe share a little bit more about those companies and what type of operations both of them were.
Yeah, one of them was oddly enough, they really didn't compete with each other. They're right down the street. One of them was primarily an open deck carrier, did a lot of heavy haul stuff, and then had a sizable logistics division that built up over the years. It was a very small company when I started. I mean, they were 20 trucks and didn't even have a logistics division. And I think when I left, we were getting close to $200 million in revenue.
Wow.
And then the other company has been around for almost 40 years, family business. They were pretty much dry van and refrigerated. And then
Okay.
they started a logistics operation during my tenure with them as well, which has continued to do well and over the years. So
Great.
two good family businesses. Like I said, their sons are friends, so it was kind of interesting dynamic.
Yeah, no, that's great experience, though, particularly for what you're doing now. So now you work as a virtual CFO at Summit, which is an Anders entity, I believe. So maybe share a little bit more about, I know a lot of our audience is familiar with Anders, but Summit Virtual CFO, what that organization is and kind of your respective role within it.
Exactly. Summit formed about 20 years ago here in Fort Wayne,
Okay.
and Summit is just a virtual CFO service,
Okay.
and they ended up merging with Anders a little over 2 years ago, right after I joined. Right before I joined the company, they'd merged with Anders out of St. Louis,
No?
and Anders was looking to add the virtual CFO consulting wing. Anders was a traditional accounting firm, so they added Summit in as the virtual CFO consulting wing of the company. And it's been a really nice merger. Anders has provided a lot more bandwidth for Summit, a lot more resources and so forth. And then Summit's been able to go in and work with some of the clients of Anders, provide virtual CFO services.
Yeah, that's great. And I know our audience, really vast array and ranges from small to mid-size operators to pretty large, sophisticated organizations as well, all of which have different financial structures within their companies, but some of which might not be familiar with the virtual CFO capability. So maybe you can kick us off there and just share a little bit more about what that service is and what you offer.
Absolutely. Yeah, a lot of companies aren't familiar with what we do. When you say a virtual CFO, they kind of look kind of glassy eyed, and what is that? And
Sure.
we come in on a fractional basis, and we provide mid-sized companies. They're kind of in that transition from, the bookkeeper or a small controller, and then they find themselves growing, and they get a little bit anxious about decisions they're making. And they're like, they just don't feel like the ownership or management team just feels like they need some more guidance. And they're not quite big enough for a full-time CFO. So that's where we come in, and we can provide that expertise. Someone like myself, that has 25 years experience in the industry, can come in and provide them the expertise on a part-time basis. And we also come along, some of our companies have experienced controllers or CFOs, and we come in and kind of work alongside them and just as a good sounding board with them.
Yeah, that's great. And I know your organization, similar to ours, you advise companies that are about to exit or transition their businesses. Maybe share a little bit more of some of the challenges that you see in advising those organizations when they're preparing for a business exit or transition.
Absolutely. Yeah, one of the things we're always with all of our clients, whether they be a transportation company or a digital agency or manufacturing company, one of the top priorities for a CFO, whether it's a virtual CFO or an internal CFO,
Yeah,
is we should always be consulting with the ownership team about a succession plan.
sure.
We should, and I know you can relate to that.
Yeah,
So we as CFOs should be always preparing them for that succession plan. And probably one of the biggest things that I see, especially in the transportation world, because the accounting can be very complex in transportation, is to make sure the financials are clean and in accordance with generally accepted accounting principles. And a lot of people, they think their financials are clean until, you get a CPA in and actually really combing through them. Well, we're in there every month looking at the financials and making sure all the transactions are recorded properly so that when they do get ready and they're talking to someone like you and your firm, that they're not explaining, ups and downs in the financial performance. The
sure.
buyer doesn't have as many questions. The financials are grouped according, to how they should be grouped, for a transportation company.
Yeah.
And that provides that buyer with so much more confidence when they're coming in and looking at the statements, they know they're accurate.
Yeah, I think that's great. And, one of the questions we get often is, when should I start the process? And we hear it all the time where individuals will come to our organization and say, yeah, I'm interested in exiting, but maybe not for 6 more months. And then we have to really explain, the life cycle of a transaction. So maybe share with our audience from your perspective, how far in advance would you recommend that a client truly start preparing for the sale of their business?
I would recommend at least a year in advance. I mean, obviously the longer the better, but a minimum a year. We recommend to have at least 3 years clean financials, hopefully even more. And I know your firms like yours would love to see that as well.
Sure,
You don't
absolutely.
want to see 1 year of clean financials. You need a history.
Right.
So I would recommend at least 1 year in advance, if not 3 to 5 years. It's an ongoing process, and preparing for the due diligence even can be overwhelming. So we recommend to our clients that they start that process, chip away at it over the years and accumulate documents and look at their business through the eyes of a buyer, through the eyes of an
Mhm.
investor.
Yeah.
What would they be selling someday? And not only looking at preparing their business for sale, they also need to do some calculations as far as, they run an EBITDA calculation and say, all right, my business is worth $5 million. Well, what's it going to be after tax? After they pay off debt, after they pay off some professional fees, what can they expect in their pocket? So the sooner they can start doing those calculations, um, one of the things I would hate to see a business owner is they're getting ready to hang it up and they just start accumulating all this stuff and rushing and they really haven't planned for it. So at least 1 year in advance, we'd want to see someone
Yeah,
get
I think
ready.
that is, yeah, just great advice. So, talk to me about those recommendations. Are there key areas or recommendations that you would make to your clients that are preparing to start that exit process?
Yeah, in addition to having clean financials prepared and making sure, everything's in accordance with generally accepted accounting principles, even an accounting review to have an independent third party review the statements. A lot of our clients still go through that even though we're preparing the statements.
Yes.
Secondly, having a forecast, not only taking those financials and then being able to forecast for a prospective buyer and for their own management use to run their company, to create a dynamic forecast so that they can show a prospective buyer, here's where we're going, here's some opportunities for improvement and so forth. So I think clean financials, make sure those financials are grouped properly, the expenses are grouped properly. I just worked with a client today. I spent all morning, we're getting them set up, and I've been spending all morning trying to make sure their financials are grouped and meaningful so we can compare, do some benchmarking against the ATRI or, prior years, and they've got good, solid information to help manage the business and also for projections forward.
Yeah, I think that's great. I think having a tangible pro forma is always helpful throughout the process. So, what about tax? Talk to me a little bit about tax considerations that a seller might consider throughout this process as well.
Yeah, that's something a lot of us forget, right? They go to sell their business and they have a big number in their mind of what they're going to sell it for, but the tax man's always going to become knocking on the door as well. So there's, especially in the transportation industry, if you've got a lot of depreciation you've taken for tax purposes, now you're going to probably have to recapture that depreciation when you sell those assets. So there could be a big tax bill. And there's also an opportunity, and again, Meg, I'm not a tax expert anymore, not that I ever was, but there is an opportunity available for businesses that's called a 1202 exclusion. And if a business were to sell the stock of the company, which is hard to do in transportation, as you know, because of assuming liabilities and everything, but it's an opportunity. If they can sell the stock of a company, they may qualify for 100% exclusion of the gain. It's a huge tax benefit to the seller, and it could be a negotiating tool with the seller and the buyer to maybe negotiate the price
Sure.
when they're negotiating everything.
So, talk to me a little bit about free cash flow. What do you recommend that a client, how do they project out the amount of cash that they'll need kind of out of pocket throughout the process when it comes to advisors and certainly, fractional CFO type of services?
We recommend to clients just a standard rule of thumb that they have 10% of a year's revenue is in their operating cash,
Yep.
at least available, if not in cash, at least accessible through a line of credit.
Okay.
And then we work with our clients, as you know, in trucking, you have a lot of tax depreciation and so forth.
Yeah,
So a
sure.
client may go 1 year and may not owe any tax, but it's coming the next year or the year after.
Yep.
So we recommend we reserve that, at least have that not on the balance sheet if they're an S corporation or something like that, but at least have that money set aside so there's no surprises. So when the tax bill comes, they've got the cash set aside, they're prepared for it, and ready to cut the check for IRS.
Yeah, that's great. And talk to me a little bit about business value. So a lot of the companies that we meet with on an ongoing basis, really this advisory services space, it's a lot of education, right? Many of the companies that we speak to, they've never been through a transaction before. It's typically family owned and operated, second, third generation organizations. The majority of their wealth is truly tied up in this transaction. And they don't always know all of the value drivers in their business. And so typically the first couple months that we start interacting with clients, it's really just an educational process.
Mm-hmm.
So maybe share with our audience a little bit more about opportunities that a seller should consider in order to maximize their business value from your perspective.
Yeah, I think some of the key, other than just how the financials look, some of the other key factors would be make sure they're diversified across customer base. Clients that have high concentration with a single customer, and as you know, they go to sell, and a buyer's going to look at that, and they know if that customer walks, they could lose 30-40% of the business. And also across industries, make sure they're diversifying across. If they're all tied up to the automotive industry, and that goes into the tank for a little while, they're going to lose a lot of business. Making sure the receivables are clean is huge. As part of general accepted accounting principles, make sure they have a reserve set up for any bad debts and so forth. Their management team, as you know, what are they selling? What's the team look like if the owner leaves? If he or she is the key employee and has the key relationships with clients or customers, then what are they selling? So making sure that they've got a strong management team to pick up right behind them, their age of their drivers, their driver pool, how long they've been with them, the tenure with the drivers, and those are huge factors that are going to impact the value of the company.
Yeah, I think that's great advice too. I've always used a few different stories from my past of working in trucking companies as well. Um, I had a head of sales once who, his North Star was really adding more customers to the mix, and this was a sub $100 million asset based trucking company, and it got to the point where we had 1,000 customers, right, as part of our customer base, and so it's also a balance, right, because there's a point of no return where an incremental customer doing a few loads or transactional volume might not be advantageous, right? And so in that scenario, I actually had to say, hey, adding more clients isn't actually
Right.
the North Star. We need to cut the tail of our customer base damn near in half and take that capacity and put it into our middle market most profitable volume. And so
Exactly.
you're absolutely right. I mean, client, diversification, it can go both ways, right? You absolutely want to be diversified. We don't like to see 50, 60, 70% of revenue tied into a single account. But we also don't like to see a tail of customers just for the sake of saying you've got 1,000 plus, customers in the mix, and therefore you might not be handling the most profitable freight either. And so I think that's really important. We also had another scenario on the asset light side, a pretty large brokerage operation. And, the executive team, their North Star was really adding more and more locations, right? And they had this vision of going from 15 dots on a network map to about 30 and doubling their footprint. But every incremental location that they added, the profitability margins kept dropping because
Hmm.
processes, people process technology, it just wasn't repeatable or ran as efficiently as home office. And so ultimately, they did grow their network footprint pretty significantly, but their profit margins and EBITDA margins dropped pretty significantly throughout that process. And so, therefore, that can be a disadvantage as well. And so, yeah, I absolutely think understanding value drivers, what the North Star is, how buyers view deals and transactions, free cash flow, what's most important to the buyer group, it's just really important throughout that educational journey.
Exactly. Setting up, I'm glad you touched base on that. Having too many customers is a problem too.
Yeah,
You
for
know,
sure.
you get very inefficient. You've got to set up a new customer. You don't know how their billing works and everything, and then you're
Sure.
chasing money. So that can be as problematic as having too few customers.
Yep.
So, we'd had that issue in my past life of just becoming very inefficient and maybe not doing proper credit checks on those customers either because you're just anxious for the business. And
Yeah,
as we all know, owners can get really hung up in the revenue number,
that's right.
and they can really, it's an ego thing sometimes, and you need revenue to drive profitability, but
Sure.
sometimes you can get too focused on sacrificing profit. Exact as you said, you become less efficient, and your next thing you know, your margins drop to you're almost not making any money on that incremental business.
Yeah, sometimes it's advantageous to shrink, right? Whether it's asset count, customer base, et cetera. So,
Hmm.
yeah, no,
Exactly.
I think it's great to have just such an experienced team of advisors around the table that have been through a process. Tax, CPAs, your legal counsel, all of these different advisory groups can really be helpful throughout a process. Many times if you don't have that lined out and you don't have the expectations that are clearly set, it leads to a lot of fatigue and frustration throughout a process as well.
When companies come to you, Meg, do they usually have an idea of what they think their business is worth before they start talking to you, or
It really depends. Sometimes
yeah.
yes, sometimes no. I would say, as many times as not, we're educating the market on how deals within transportation and logistics are actually transacting.
Hmm.
Whether that's a multiple of EBITDA or whether that's an asset, a truck and trailer and driver, combination. So it really just depends.
Yeah, I think it's important for someone like me to counsel that owner through. All right, what's your number? What do you need, or what do you think you would want to walk away from your business?
Sure.
And then to say, all right, here's the number you said. Let's start backing into that.
Mhm.
Is that a realistic number? Let's look at your EBITDA. Let's
Yeah.
do it. A quick and dirty valuation and see if we're even close. And then
Sure.
start talking about, just like we've talked about, what are those drivers that can, if there's a gap between what they want and where we think they are, what's the drivers to get them to that next step?
Yeah,
Because it's
that's
not
right.
going to happen just magically.
Sure.
There's got to be a strategy in place and be intentional about getting there, right? I mean, be
Yes.
intentional about adding the management talent, to support them, if and when they sell the company.
Yeah, absolutely. And I think the other half of the education isn't just solely around valuation, but I would say it's almost more so around deal structure right now. And so, oftentimes when there is a valuation gap, structuring a deal to have some type of an earnout component,
Hmm.
it can also help to bridge that valuation gap frequently.
Yeah, I think a lot of owners probably think they're just going to walk. They're going to write a check to them, right, and they're going to walk away.
Sure.
But there are a lot of strategies, whether it's an earnout or whether they stay on for a few years, in a management capacity or whatever that looks
Seller
like.
financing, right? Pretty prevalent right now
Exactly.
with interest rates.
You
So,
know,
yeah,
and are they willing to do that? Are they willing to carry some paper? And who's the
sure.
buyer? That depends on who the buyer is, right? If they feel comfortable with them from a credit standpoint, and they don't want to come back into the business. They're done usually,
Yep,
so they don't want to get it back. So
that's
yeah,
right.
the structure of the deal is something definitely they should be looking at and considering in all this calculations.
Yeah, and I think we've spent some time on the financial side of the equation. Then there's the whole non-economic side of the equation, right? And I've seen some pretty amazing stories since I've been at Tenny Group around sellers that have gone to market, and they have actually put their, as part of their non-negotiables, the non-economic needs of the organization above the economic needs, right? And so
Right.
whether that's ways in which to take care of key talent, remaining at the location or community in which they've kind of built this legacy. There's all different non-economic needs that
Hmm.
sellers have throughout the process, and sometimes those end up being more important than the financial side.
Yeah, I can see that. I mean, they've invested their life in their business. Some of them, they've spent 20, 30, 40 years, perhaps building it. They've got a strong relationship with their employees. They want to
Sure.
see them handled properly. They don't want to just get a check and walk away. There's a lot of emotion tied to that as well versus just getting a check and walking away. Usually, I could.
Yeah, no, absolutely. And it's amazing just to see ways in which they can give back to their employees and their community and affiliations that they're, care deeply about. So, just really neat stories around what's next after, transaction actually occurs too.
What percentage of your clients would you say you would you would rate that they are ready, prepared for the sale process? That they actually have a succession plan.
Yeah, that'd be a great question for our execution team. I would say oftentimes when we start engaging with an individual, we spend anywhere from a month to a year just nurturing that relationship.
Hmm.
Until they're ready and to a point of which they're educated, their ducks are in a row, and it makes sense for them to engage. So that was a pretty, that was a vast timeline I just gave, but some are more prepared than others, right? Some
Hmm.
CEOs have been through an M&A process. They understand all the things it takes to go to market. And so others, again, it's their first time going through the process. And so just educating them on the data needs and requirements, timing, the conversations that are going to occur, making sure they have the time and the resources to clear their plate in order to focus
Hmm.
here on the diligence process. So it really just depends on how I think experienced some of the sellers are that end up listing.
Hmm. Yeah, I just went through due diligence with a client not long ago, and it was overwhelming for him. The amount of information required, and we did a lot of hand holding through that and helped provide information and counseled him on, just the process and everything. Because there's a lot of anxiety over it.
Oh,
So the sooner they can prepare for that and be ready and have all those documents, much as you can have ready and in place, so that you're not scrambling to find copies of tax returns, and an org structure, and who's your management team and stuff like that, and putting all that together, the sooner the better, in my opinion.
and again, your team around the table hopefully can drive a lot of efficiencies for you throughout that process, right? So, well, great. It's been a great discussion. I know it's a really tough, obviously challenging year for transportation and logistics companies across the board. So, talking about maybe what you're most optimistic about. What are you most optimistic about, maybe through the end of the year or early next year in this space?
Yeah, I think we're starting to come out of the rate depression a little bit. I've seen some indications from some of the shippers and stuff that they expect rates to come up. I've seen some statistics on that. So I think that we went through an odd period, with COVID, very odd period. We've never been through it. I've never been through anything like that, obviously, in my 25 years plus in the industry.
Yes.
And I think with coming out of that really strong, some carriers were able to hang on a little bit longer than normal, some of the smaller carriers.
Yeah.
And I think some of the government money that went out, to the carriers, it kind of disrupted the market. Normally you see a swing that goes, for a year or two, then comes back. And I've seen it over the 25 years, up and down, up and down. This one seemed to last a little bit longer than
Absolutely.
what I've anticipated. But I anticipate the summer is going to be fairly strong. I don't think it's going to be robust like we saw coming out of the COVID period, but I think we're going to start seeing rates come up. I'm already seeing it with a couple of my clients. Margins are improving.
Good.
Nothing to write home about, but seeing some improvements that are looking positive for the next few months.
Yeah, that's great. So Dan, if our audience wants to get in contact with you, where would they go to do that?
They can reach us at the Anders website, anders.com, or email me at drutherford@anderscpa.com, and we can set up an hour consultation and just chat about our services. It'd be rare that we couldn't come in and help with something. And our services range from coming in and doing just basic accounting work, helping close the books, all the way through to virtual CFO services where we're meeting every week, doing cash flow, and we're in there. I'll say as much as a full-time CFO, but every week we're meeting with our clients.
Wonderful. Well, Dan, thanks so much for joining me on the hot seat today. I really appreciate it. It was a great conversation.